Holy cow, what a week for cloud computing stocks. In case you missed it, the OG cloud computing company, software as a service SaaS company, Salesforce, just destroyed its earnings and soared 30% on the week. And because of that, the rest of the cloud computing sector got pulled up with it. This is one of the hottest sectors in the market right now. It's really enabled what's needed to in this time of the pandemic. The work from home trend, the schooling at home trend, socializing at home, all this is made possible because of cloud computing and data services. The software is held elsewhere, and we're able to use that to get on and connect to the rest of the world. And it's what keeps businesses running, it's what keeps your networks running. But is it too late to buy these stocks now that they've already soared? Well, I'll tell you. But first, we got to talk beer. Today I'm drinking a Citra on the dock of the bay, produced by one of my favorite breweries here in Wisconsin, the Eagle Park Brewery. Definitely had a couple of their drinks before. It's my last week in Wisconsin. I wanted to definitely leave with a few of these beers, sample them, try them, and leave with a good taste in my mouth. So let's see how we do. Yep, this is it. So Eagle Park's really known for their IPAs and their sours and slushies. I think I mentioned before, and this is a New England hazy IPA, and if you can see this is really what a IPA should look like. Just thick, cloudy, almost kind of milky looking. You shouldn't be able to see through your beer, and it tastes just like you'd hope it would. A little bit of citrus on the tongue, but you still get the hops. This is really good. I give it, we'll say, 8.5 out of 10. I think that's the highest rated beer we've had so far. Yum. And before we get going, this isn't financial advice. Sure, I got a few letters after my name which imply I know what I'm talking about, but really I'm just a guy here drinking some beer. And that's really, maybe it's good financial advice I'm giving, maybe it's not. Do your own homework before buying or selling any stocks is really what it comes down to. I'm not responsible for your actions. All right, now let's talk cloud stocks. Oh yeah, before we get going on that, if you like this video at any time, please hit the like button below, subscribe to my channel so you get alerted to any time I release a new video. And it helps bump me up in the algorithms and make this message available to more people. It keeps me motivated to make more. It makes me excited to get a little dopamine rush every time I get a new subscriber. It makes me feel good. So please do that. It helps me out, helps the channel out, and helps everybody grow our wealth. All right, now on to the cloud stocks for earlier. Salesforce, one of the two largest software companies operating purely in the cloud. The other one's Adobe. But Salesforce destroyed its estimates. Wall Street analysts were calling this earnings report jaw-dropping and stupendous. Revenue only came in 4% higher, which doesn't seem like that much, but that was almost $1 billion higher than anticipated for just this quarter alone. And that's a 20% rise from this quarter last year. And earnings jumped 82% from this quarter last year. I mean, Salesforce is firing on all cylinders. And it's a little surprising to the market because earlier, after the first quarter, they actually lowered their estimates a little bit because they weren't sure how the pandemic was going to impact them. If employers were laying off a bunch of people, they would be losing a number of seats that they collect revenue on. I mean, most of these contracts have a base that they hit no matter what, a base payment that they receive. But more employees generally implies more seats and more revenues for Salesforce. So all these potential layoffs was not good. But companies realized they needed Salesforce's customer relationship management software to run their business in an effective way. When employees are all over the place, scattered, they're not in the same building anymore, they can't connect and have meetings and sit together and plot in person, they really need to know what is going on with the customer relationship, especially for a big one where there might be multiple people talking to a client. You have to have that continuity, we'll call it, of relationship and communication. Otherwise, any client will get a little irritated. So a lot of businesses obviously found Salesforce's software to be beneficial for their services that they provide their clients. And they are paying for Salesforce's platform. And that's a good thing. And Salesforce thinks that this revenue gain will become permanent moving forward. And that's really what's important for investors. It's moving forward. Going forward, Salesforce raised their full fiscal year guidance for revenue and profits. And if Salesforce is going to have permanent revenue, it's very, very likely other cloud companies will have permanent revenue from this as well. And that's why the whole sector got pulled up with Salesforce. And Salesforce is a $250 billion company now. As I said, it's one of the biggest. And what happens for Salesforce has ripple effects throughout the economy. They're kind of a barometer of what's going on. So like when Amazon has good sales in its retail operations, it implies internet sales are up across the board and pulls up all internet retailers in sync with it. The same thing with Salesforce. When Salesforce has good earnings and they have a good outlook moving forward, it's going to pull up the whole cloud computing software as a service segment with them. And that's exactly what happened this week.
So let's start by looking at Salesforce. As you can see in the chart here, we started the week at $210 and we ended the week at about $271. It's a huge move, and that's really what propelled the entire cloud computing market forward. I mean, we look at some other stocks right now. There's Microsoft. They have a big cloud computing service. They're Azure cloud service. Let's see when it loads. And it's a little slow up here in the boonies. But yeah, you'll see Microsoft went from 215 to 229. And then Facebook also had a big week. They went from 270 to 293 here. Amazon here went from 3,300 to 3,400 on the week. Workday had itself a nice little earnings report over the week as well. It started out at 190 and ended up at 243. Just a massive move for this company that makes essentially accounting software in the cloud. Okta had itself a nice move from 205 up to about 225 on the back of the Salesforce earnings, but then Okta had its own earnings and they announced that they might have some headwinds in the second half of the year. I don't really know what they're talking about. Every other cloud computing company seems to be looking forward, but Okta is going to have some problems. As you can see down here as well, like they've got severely lowering a MACD. And that could be signifying that the momentum that Okta's shown lately is running out. So I'd be wary of Okta. I might even buy puts on that soon. That's looking really ugly. Anyways, we have Fastly here. They went from 85 to almost 95 on the week. Another nice move for a cloud company. Zoom, which has pretty much been the poster child of the pandemic, went from about 283 to 299. That's another solid move on the week. We have Cloudflare moving from 38 to 39.65. I mean, that might not sound like much, but that's a 3-4% move on a week. That's pretty good for any company, and Cloudflare is no exception.
So cloud stocks are looking great right now, but should you jump into the fray after this run? Well, to be honest, it depends on your strategy. If you're a trader and you're just buying for a short-term move, sure, you can go ahead and try to play the trend up. These stocks have recently broken out to new all-time highs, and generally breakouts is a good time to buy. But you have to know as a trader, you have to have your exit planned precisely. You got to know when you're getting out, because eventually these stocks are going to go down. And as an investor, I would stay away. And here's why, as an investor, I would stay away.
What I'm showing you here is a chart of the historical EV to trailing 12-month sales for the companies. And this is a common metric used in technology investing, to use the EV to sales, because a lot of up-and-coming technology companies don't show paper profits yet. So you get metrics like the price to earnings ratio, the PE ratio, which many people use, or EV to EBITDA ratio are meaningless because the earnings or EBITDA are negative. I don't like to do this often. I prefer to show you things that you can find on your own with a free service, but I don't know any free site that shows you charts like this of the historical valuations of companies. So I'm going to use the Bloomberg terminal to show you what I mean when I say these companies are expensive. I mean, as you can tell, we have Salesforce right here, and we have, over the past 10 years, here's the EV to 12-month sales ratio. And as you can see, Salesforce just went to the highest valuation it's had in well over a decade. I mean, we can go back a little further and see if it's ever been that high, but it's really kind of just, yeah. So the last time it was that high was, in 2006, but it was a much smaller company, and it's not really fair to compare the two valuations at that time. But yeah, over the past 10 years, it's the highest valuation ever. So let's look at a couple other companies and see how that compares as well. So here we have Microsoft. I mean, as you can tell from 2010, it was trading at EV to sales of, close to 2, and now it's at an EV to sales of 11.7. No way a company the size of Microsoft should be trading at a valuation this high. I mean, I believe the EV of Microsoft is 1.6, $1.7 trillion dollars. I mean, when you have a valuation this high, you got to be able to grow into it. And a, a company that's worth $1.7 billion isn't going to grow into a valuation. It's already grown into it. So I get a little nervous when I see a company like Microsoft trading this high. And we have Facebook here. I mean, as you can tell, it's traded higher in the past, but Facebook is a $700-800 billion company, and it's trading at EV to sales of 10.5. That's still pretty high. I mean, Facebook's probably growing a little faster than Microsoft, but I still get nervous when I see it this high. So Facebook's not as ridiculous as some of the rest, but it's still getting up there. That Amazon's reaching a pretty high valuation too. Definitely its highest in the past 10 years. Its EV to sales is only, and I say only in quotes, 5.35. But Amazon is a very different business than Microsoft and Facebook. So it usually trades at a lower valuation. And Workday is actually, like, for a fast growing SaaS company, it's actually trading reasonable ish. It was pretty low historically from where it was before its earnings. It was trading around 10, but now after this past week, it's up to around 14. That's still pretty high. I'd use its last 5 years here as kind of the basis. And now it's trading at the higher end of the valuation. So I'd get a little nervous about investing in Workday at this point. And then you'll see some of these other ones are just at ridiculous values. So let's see if we can get Okta on here. Here we have Okta, and it hasn't been publicly traded for as long as the rest. So you'll see it only started in 2017. But you can still see it's at just a ridiculously high valuation right now. I'm going to turn it back to the 5 years because I think most of these are pretty easy companies. So you can tell, like, a valuation of 37 on the EV to sales, that's just crazy high. It's got to grow at a ridiculous pace to make that happen. And then we have Fastly, which I believe is an even newer company. Yeah, as you can tell, it started in 2019 here. But that's got an EV to sales of 39. I mean, that's just insane. And then Cloudflare has an EV to sales of over 40, which is also ridiculous. But then once we see Zoom, I mean, Zoom almost makes these guys look cheap on a comparative basis. Zoom here has an EV to sales of over 100. I mean, there's no way any company should ever trade at a valuation of an EV to sales over 100. A company like Zoom, even growing as fast as it is, it should grow, or it should have a valuation of like an EV to sales of 6 to 8. So to get to that valuation, the stock needs to fall 94%. And to fall 94% is, I mean, no one's going to hang on through that whole thing. No investor is going to do that. And to recover from a 94% loss would just take forever.
So as you can see, cloud stocks are extremely expensive, the most they have ever been in their history. So that makes it a very risky time to buy these companies. Yeah, you want to buy a breakout in price level. You do not want to buy a breakout higher in valuation because prices can just keep going and going and going. However, valuations have a tendency to revert to their mean and just go up and down in a certain range. And that's why it makes it very dangerous to buy stocks when they're valued at their highest valuations ever. And that's the case right now for these cloud companies. So tread carefully. And I believe we're on the cusp of seeing a market pullback. We have so much uncertainty in the market right now. With the pandemic, with the economy, with the presidential election. I mean, both sides are just gearing up for a fight after the election day, not whether mail-in voting, is all the ballots counted, are they not? What happened in person? Like, I mean, they're just gearing up for a fight already. It's going to be uncertainty. That's what dragged things down after 2000. That was what really popped that bubble. I mean, sure, it topped out in June that year. And it was a hanging chad debacle, which really brought the market down in a big way in the fall of 2000 when Florida has uncontested results. Market just got crushed at that time, and that could really happen again. Like, it's the same kind of thing. The market just appears to be melting up, melting up, melting up. We're seeing ridiculous valuations, and then a presidential election, you know, undecided match happens. I mean, the parallels are uncanny right now. So I'd be very, very careful. It's unlikely the market continues this path straight up. And when that market actually corrects, it'll be a huge buying opportunity. And when that happens, I'll be here to tell you which stocks are the ones to buy for this next bull run. But until then, cheers.